Start with the reality of small retail. Record keeping is usually a chaotic blend of physical receipts, manual ledgers, and shoeboxes full of unorganized invoices. When a business runs this way, personal and business funds inevitably mix. The owner effectively loses the ability to track their actual profit. Components. First, people operating the system. Next, procedures for data collection. And third, raw data of business transactions. Then the technology, software applications, and IT infrastructure to run them. Finally, internal controls safeguard against error and fraud. A glitch in a social app might only disrupt a user's feed. However, a failure in a financial system can result in severe tax penalties, lost revenue, and the permanent loss of historical records. Engineering an SIA means digitally enforcing rigid, century-old accounting principles within the codebase. In Indonesia, the compliance standard for small enterprises is known as SAK-EMKM. Any system you build must generate specific reports to meet this standard. The first mandatory output is the balance sheet, which tracks assets against liabilities and equity. You also need an income statement to track revenue and operational expenses, and detailed notes to explain the math behind those numbers. In order to generate these precise reports, the underlying database must function as more than a simple digital notepad. The system logic is governed entirely by the bedrock mathematical axiom of accounting. Assets must always equal liabilities plus equity. Double-entry bookkeeping maintains this exact balance. Every single input into the database must automatically generate an equal and opposite entry in a corresponding column. If a user tries to input a single-sided transaction, or if the numbers do not match, the system rejects the data to prevent the scale from tipping. As the system architect, you must hard-code these rejections directly into the foundational database layer. The architecture itself must mathematically prevent out-of-balance data from ever existing, long before an error can reach the user interface. Coordinating the build of such a complex system requires a structured project management approach. This roadmap is the System Development Lifecycle, or SDLC, which guides the project from initial analysis through final maintenance. The waterfall methodology is sequential and heavily documented, moving strictly downward from one phase to the next. Pure waterfall proves too rigid for SME accounting, as it cannot easily accommodate changes to the user interface once development has started. Alternatively, the agile methodology uses fast, flexible iterations called sprints. However, rapid iteration is dangerous when applied to immutable accounting rules. The core codebase must remain stable to ensure financial integrity. The solution is a hybrid model, combining the strictness of waterfall with the flexibility of agile. A waterfall phase at the beginning of the project locks in the database schema, the chart of accounts, and the core accounting logic. With that core in place, the team switches to agile for the user-facing features, such as sales dashboards and point-of-sale modules. This strategy matches the project methodology to the risk profile. Rigid frameworks guarantee compliance, while flexible frameworks maximize usability. Within the 6-component framework, financial data remains highly vulnerable to human behavior. Without strict internal controls, an accounting system introduces significant operational risk to the business. Data encryption serves as the first line of defense, scrambling records so they remain unreadable if intercepted. Multi-factor authentication then verifies identity at the login level, requiring both a password and a secondary code. The system must also be secured internally to prevent authorized employees from attempting unauthorized actions. Role-based access control, or RBAC, segments these permissions. A cashier can be granted access to input daily sales, while being blocked from the Delete Transaction menu. Through RBAC, the system ensures that only verified managers or owners possess the administrative privileges required to alter historical data. Accountability is further maintained through the audit trail. Every time a user alters data, the system automatically generates a permanent, time-stamped record of who performed the action and when. In financial systems, true security is an architectural requirement that must be deeply integrated into every single layer of the code. Deploying a financial system carries immense operational risk that continues even after the code is finalized. User acceptance testing allows business owners to verify that the software meets their real-world requirements before full deployment. The final challenge is the migration of months of manual paper accounting into the new digital infrastructure. In a parallel running strategy, the business maintains its paper ledgers while simultaneously entering the same data into the new software for several months. This provides a safety net if the software fails, though it requires double the effort from the staff. Alternatively, the cutoff method involves selecting a specific date to permanently abandon the old manual system and transition exclusively to the new software. While the cutoff is efficient, it leaves the business vulnerable if the new system experiences a critical failure on day one. This choice requires the project manager to weigh technical efficiency against the specific risk tolerance of the SME. The process involves translating accounting math into a secure database, managing development through a hybrid methodology, and executing a safe deployment. The role of the IT professional is to bridge the gap between rigorous regulatory compliance and secure, efficient digital architecture.